All right, so now we're going to get into activity-based depreciation. We're also going to go through the depletion example since it's pretty similar. We'll just kind of jump into it. So obviously the ones we've talked about before were time-based, and now we're going to do more activity-based. And so we kind of ignore the time element and instead focus on how much we're using it, the asset, whatever that asset is. And so you can base this on inputs or outputs. The most common one, though, is units of production, which is more of an output base. And so, basically, if there's some machine that I'm going to use and so many units I'm going to try to produce, well, then I'm going to sort of measure the usage or depreciation of that equipment by the number of units that it's producing. And so, again, the key here is though you're basing everything on units and kind of ignoring the time element. So going back to our example, the depreciation rate is going to be that capitalized cost, which doesn't change, and the residual value doesn't change. But now in the denominator, we're going to use estimated total units that should be units of production. And so the depletion rate, or sorry, the depreciation rate, again, is going to be focused on production. And so in our example, the depreciation rate would be, again, that capitalized cost of 425, the residual value of 75,000. And then if you remember in the problem, we estimated the number of units that it would produce is 250,000 units. Now, obviously we don't know when it's going to reach that. It might reach it in the 4 years. It might take longer. But basically, as soon as you reach that number of units, you stop depreciating the piece of equipment. And so in this case, the rate would be $1.40 per unit. And again, the depreciable base, that 350,000, that's still the number. We're just going to get there through production rather than over time. And so the actual production that we had talked about was 85,000, 75,000, 65,000, and 50,000. And the depreciation rate we calculated just on the previous slide is $1.40. And so in the first year, of course, we take that 85,000 units, we depreciate by $1.40 per unit, which means we get a total of 119. And of course, the end of your book value is that 425, which is the cost, capitalized cost minus accumulated depreciation of 119 gives us 306. And we do the same thing in years 2 and years 3. And then in year 4, it's a little bit different because if we use the rate, we would have gone over. But essentially, once you hit $350,000 in accumulated depreciation, which is the depreciable base, you stop depreciating, which means there's only $35,000 left to depreciate in the 4th year. So once we hit the 350, we stop. Now, one thing I said in class, and the question was, I don't know if both classes asked it, but just I want to highlight here is somebody asked basically, well, what if we're a little short? And I misspoke, and I just wasn't thinking through it that clearly because I was just honestly hadn't anticipated the question. But if you're short, let's say that they, reach were a little bit short. Well, when we're using activity, we ignore the time. And so we're just going to keep using this rate until we hit that depreciable base. And so if for some reason we had landed, let's say we only did like 10,000 units in year 4, then we would only depreciate 14,000. And then obviously there'd be another 21,000 units before, whatever, not 21,000, but whatever get us to another $21,000 of depreciation. And so it could go over the years because again, we're ignoring years when we're using activity based and we're focused only on activities. But again, the key here is that as soon as you hit 350,000 in depreciable base, which is the depreciable base, we stop depreciating. So that means again, we end up at our residual value. So regardless of the method, we always end up at the residual value. So in our particular example, so that we can kind of do a year-over-year comparison, I wanted to kind of walk through the differences. So we had straight line here, double declining balance, sum of years digits, and then units of production. And so we kind of think through each one. Straight line obviously gives you a very consistent depreciation expense on an annual basis. And so, if you're similarly using it over the life of an asset, I mean, straight line kind of makes sense. And also it's going to give you a very even impact on your net income. And so, the reality is it smooths out your earnings, which a lot of companies prefer anyway. Double declining balance and sum of years digits are both accelerated methods. And so you can see that there's more depreciation early on in the life of the asset and less depreciation later on in the life of the asset. And again, that could be appropriate when you're consuming or you're using up the value or using up the cost of that equipment or using it more early on in the life of that asset. And then units of production, honestly, I think it makes the most intuitive sense. Because I mean, something like equipment, I mean, it kind of makes sense that, oh, let's depreciate based on the units that we produce. Um, and also, like if you're driving a vehicle, kind of mileage might make sense. But the only thing is that, the estimate of how many units you're going to be able to produce, or for a car, how many miles you're going to be able to drive, uh, that can be problematic, right? And so because of that large part of the estimate, it can kind of create some issues and misallocation. And then finally, straight line depreciation. That's the one that most companies use, just to kind of give you an idea. Nearly all firms use straight line depreciation. So depletion, we're going to kind of focus on that because similar to what we just did with depreciation, it is an activity-based method. And so most companies, that's what they're going to use. You can use time-based, but we're going to focus on activity-based. And so a new example here, because again, we're going to focus on natural resources, is the company paid 2.3 million for an oil deposit. Again, this is if you remember from the couple lectures ago, we did this example. So we're just kind of bringing that one back. On the previous example, we were looking at the asset, golly, I'm blanking on it, the asset recovery, or no, it was called obligation, the asset. I don't know. It's late. But anyways, we were focused on the liability, that obligation, but now we're going to focus on the asset. Um, and so anyway, so in this case, again, same information. We have the what we paid for the oil deposit, what we paid for exploration, what we paid for development costs, and then the rigging equipment was an assumed scrap value at the end. And then the last piece is that we had done that present value calculation for the asset restoration cost, or restoration obligation. Again, I don't think we use restoration. I am completely blanking on that name. That's okay. There are worse things in life. And so now we're going to kind of include some extra information, which is that the company estimates that they're going to extract 485,000 barrels of crude oil over a 3-year period. Again, we kind of ignore the 3-year period and instead focus on the barrels of crude oil as our method for depleting the natural resource. So the actual production over the 3-year period, just to kind of illustrate that we do stop once we hit that depreciable cost, or depreciable, or in this case would be the depreciable base or depletable base. And you can see that we kind of, in total, produced more barrels than what we had expected. But again, we're going to stop our depletion as soon as we hit that depletion base or the allocation base. All right, a couple things to note. First of all, since the rigging equipment cannot be used elsewhere, you're going to depreciate the equipment using the same method that you're using for the oil deposit. And so you're going to go activity-based for the equipment. Again, the key is because the rigging equipment cannot be used elsewhere. That's a key factor. US GAAP allows depletion and the related depreciation costs to accrue to inventory instead of being directly expensed. And so essentially it gets rolled up into the cost of the crude oil. And then when you sell the crude oil, it would roll into cost of goods sold at that point in time. And that's how we're going to treat it here, is we're going to accrue it to inventory. And then note 3 is usually what you're going to do is just directly reduce the asset, the natural resource, rather than having some sort of contra asset account like accumulated depletion or something like that. So you can use a contra asset, but most companies just directly reduce that natural resource account. So that's what we're going to do as well. All right, so first you got to calculate the depletion rate for the oil deposit. Again, hopefully this looks familiar. It's very similar to the depreciation rate. And so we have the capitalized cost minus the residual value over the estimated number of barrels. And if you remember, we had previously calculated that capitalized cost at just over 4.8 million, which again is the sum of all those direct costs plus the present value of the restoration cost. And so that's what we will end up having as depletion. Natural resources, by assumption, have zero residual value. In fact, as we know, you end up paying money to restore the lane, and that's our estimated number of barrels. And so the rate of depletion is $10.02 and some change per barrel. I typically leave it out to 4 decimal places just because rounding can be a little bit problematic. But if you round it to the nearest penny, it's not like the end of the world. When you're dealing in thousands, probably not a big deal. If you were dealing in millions or billions, then those rounding errors can certainly add up. And so that's why we kind of carry it out here. Bad animation, sorry about this. But with the depreciation rate, we're going to kind of figure out how we get to that number. Again, you follow that same approach. Instead of years, you're going to use number of barrels to depreciate by activity. And so the depreciation rate, again, it's the capitalized cost minus the residual value, which in this case is 50,000, divided by the estimated number of barrels, which gives us $1.69 and some change per barrel. Again, I'm hoping these calculations aren't too difficult. And so then we have the two things basically side by side. We have the depletion of the natural resource and the depreciation of the equipment. And you can see that, obviously we bring in the rates. And so in the first year, we would deplete the natural resource a little over 1.4 million, and we would depreciate the equipment a little over 245,000. Do the same thing in the second year. And again, a couple things to keep in mind. Again, you cannot go past the depletable base, and you cannot go past the depreciable base. And so this is going to stop at the value of the natural resource, which again, going back to it, the capitalized cost of the resource is $4,863,726. We cannot deplete more than that. And on the asset side, this difference of 820,000, that is the depreciable base, and we can't go past that either. And so in that third year, if we had applied the rate, we would have gone over. And so basically, once we hit the cap, we stop. And so we don't deplete once we hit that total depletion, and we don't depreciate once we hit that depreciable base. And so that's where we would stop in the third year. And so taking that information from the tables and creating the journal entry, again, noting that we're going to accrue this or we're going to accrue these costs to the inventory. And then later on, like any other inventory, we would roll it into cost of goods sold when it's sold. But for now, we're focused on how we accrue it. And so, of course, we've got in year one, we've got the depletion of the natural resource, and we've got the depreciation of the asset. And again, normally you would have some sort of expense sitting here, but under US GAAP, instead of expenses, you roll it into an inventory account. And then eventually, again, when you sell the inventory, that's when you have cost of goods sold. In the second year, of course, the same accounts, but different amounts. And then again, in the third year, same accounts, but different same accounts, but different amounts. All right, well, I'm going to stop there, and then we'll pick up on amortization of intangible assets in the next one.